Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
Welcome back, Washington, D.C. Metro, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Reminder, the show is dedicated and designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. You know, like I said, if any questions you have in regards to refinancing or purchasing or trying to avoid foreclosure and looking at a short sale as your possible option, we're here to help. 877-245-2030. So as I was saying in the previous segment, that foreclosure activity has been reported at its lowest level in 5 years, but that doesn't necessarily mean that all of a sudden people are, paying their mortgage and are current and on time. What it really means is that the banks have gotten much smarter about the way that they deal with these issues of people not making their mortgage payments, and they're allowing for more short sales to go through. That's one reason. The second reason is many banks are actually bulk selling their non-performing notes. Now, when I say non-performing notes, it basically means when a borrower stops making payments to their bank, it's then considered a non-performing loan. Instead of Bank of America, Wells Fargo, whoever it is, whoever is servicing your mortgage at the time, foreclosing on you, they're bundling up a bunch of these bad loans, or non-performing loans, they call them, and they're selling them off to these hedge funds for probably, 20, 30, 40 cents on the dollar. Well, why would the banks do that? Well, the reason they have a lot of reasons for wanting to do it, but the main one is they don't want to have to be liable for actually seeing the note all the way through to foreclosure. And by just selling it off to a hedge fund, they get to deal with all of that, and the bank is no longer responsible for doing it. It eliminates them getting a lot of bad press from, bad foreclosure procedures. And the way they were actually going about it with all the robo-signings, it was just so much negative publicity that I think that this is just an easier way for them to handle it. So,
and Ryan, there's also another reason for them to do it, and you saw it in J.P. Morgan's results, is they can then hold a smaller provision for credit losses.
Yep.
And that boosts their results.
Absolutely. Yeah. And so, those two reasons there, that's why we're seeing that there's not near as much of foreclosure activity as what we've seen in the past. Now, many are saying, well, that's not what's going on. Obviously, our show streams across the country. We do have states that are still heavily being hit. Mainly, the states that the filings have continued to decrease are the non-judicial states. So of the 24 non-judicial states, 20 of them reported annual decreases in the foreclosure activity in the third quarter. Some were quite substantial. For example, Nevada saw a decrease of 71%, Oregon a 63%, and Utah a 60%. So, those are some substantial decreases. So I would say that, short sales are probably really ramping up in those areas because I highly doubt that the employment situation has turned that much around in Nevada that it would justify that big of a decrease. I just really don't see it. Now, for the judicial states, the filings have shot up. Now, many of the reasons why they've shot up is because there was that huge stall for about 1 year when they were going through all those lawsuits where basically banks weren't doing anything. They were just kind of sitting on those files. Now, they are actually continuing. New Jersey is one of the most active states, which had about, I think, 130% increase. New York had a jump of 53%. Also, Indiana, Pennsylvania, Connecticut, Illinois all had increases of anywhere from 31 to 36%. So there's 26 judicial procedure states, and those are the ones that the filings are jumping up on. But the non-judicial are coming down. So I believe that on a quarterly basis, the states that had the highest foreclosure rates were Florida, which was 1 in every 117 housing units, Arizona, which was 1 in 125 units, and California, which was 1 in 125 units. So, that's still showing me that, there's still a lot of foreclosure activity out there. They can say whether it's the lowest level in 5 years, but that's still quite a bit. It's pretty significant. And to couple that with the fact that, the national average is that 1 in 3 homeowners are still underwater, that doesn't necessarily bode well for the future, especially if people are unable to take advantage of the historically low interest rates.
And, Ryan, that J.P. Morgan did mention that delinquencies are still rising in many sections of their loan book.
Yep, they did.
So, you would only imagine that a lot of those delinquencies might eventually lead towards foreclosure. But Jamie Dimon said he thinks the housing market has turned a corner. So, in other words, they have to justify why they have smaller reserves for bad loans.
Yeah, absolutely. And, it's almost like, they know that the bad loans are coming, and they're going to have to deal with them. And as long as interest rates are low, they have these new production. I mean, J.P. Morgan, posted a very strong profits for the quarter. I mean, it was a net income of...
It was record income.
Yeah, reported record net income of $5.7 billion. And Wells Fargo said its income for the quarter was $4.9 billion. Now,
somehow we didn't hear anything about the trading losses, the $6 billion trading loss.
No, we haven't. It's kind of
incredible that they can make $5.3 billion probably just by reducing their loan reserves, and they can absorb some type of $6 billion loss, and it's a mere bag of shells.
Yeah, and then they have a record quarter that, it's just everything else is kind of just fallen by the wayside. Nobody's paying attention to it anymore. And now there's been many stories where Jamie Dimon should be saying thank you to the Fed for keeping interest rates low because it's been able to boost their overall mortgage production. Obviously, we've seen by interest rates staying low, it's driven the stock market up, so the asset management of these companies, which I'm sure they have huge portfolios, especially J.P. Morgan and Wells, has led to probably more fees on that side. So,
and is the Fed buying their bad debt?
Yeah.
Their mortgage-backed securities to make
absolutely
them better.
So, while they can complain all day long, many of these CEOs, they're still in probably the best position possible because they're borrowing money for next to nothing. They're giving out, low interest rate mortgages, but to them, it's what does it really matter? Because they're not. It's not like they're approving every loan. They're taking cream of the crop loans. It was very. No risk to them really because they can handpick which ones they want and don't want, and they can say all day long that they're not doing that. But
and if they don't work out, the Fed will buy them anyway.
Right, and I've seen firsthand that it's so difficult for people, even well-qualified people, to get loans these days. And the frustration level's through the roof because many people, at a certain point, they're just like, well, you know what, I'm not going to buy a house. This is just not, it's not going to work. And, that shouldn't have to happen. But it is the reality of where we're at right now. Many people have asked me where I think things are going to go. Like, meaning in the next year, do I see mortgage underwriting guidelines easing up? And I can't say that I really see that. As long as we see a low interest rate environment, to what benefit or why would it make sense for banks to start to ease their guidelines? It wouldn't. Now, if interest rates were to start to come up and there's more return for these banks or investors, then I could see that they would get a bit more aggressive on the underwriting side and start lending, more leniently, but only when
to accommodate their risk.
Exactly, but there's only a rate of return that they're going to be willing to do that, and at the 3% level, it's not going to happen.
They should be tightening them.
Exactly. Well, and it still boggles my mind. I talked about this on a prior show because you have debt-to-income ratios where when you're trying to buy a home, you're allowed to go up to certain qualifying ratios as a proportion of your income and what your housing payment is, plus all your other debts. Well, for some, that cutoff is 50%. But I've seen certain loans go through with up to a 57% back-end ratio. So 57% of your total gross monthly income is going to be your mortgage payment and all of your other debts going out there. Now, that doesn't even count your food, your electricity, all the other bills. Now, rationally, how could one think that they can make their mortgage payment and live comfortably, be able to save money, put some money in the bank, put some money in their retirement, if you're already spending out 57%?
Well, saving and putting money in retirement has to be out. And if you've got a credit card for living expenses and you're expecting a raise, that's how you do it.
Yeah, and then that would be the only way is if somebody is consistently, waiting for a raise, or they have another part-time job that, could not be included on the job application, that there was more money there.
Or they're getting family support or something else, right?
Yeah, but there has to be something.
On the stated income, they're not. That's not a healthy ratio.
Right, but the reality is, Lewis, is that the majority of people don't have those things.
Correct.
And they are still
outliers.
Exactly, and more people are still doing what was, what caused the last housing crisis, which is still kind of, overextending themselves. Because even when you have a low interest rate environment, it's very easy to still overextend yourself, because instead of buying a $200,000 house, you buy a $300,000 home.
It's even more deceptive. You think that the interest rates are low, you still have to pay the money. The
Yep.
net amount is still the net amount versus your after-tax income.
And see, the worst thing that I think people could possibly do right now is to overextend themselves on historically low interest rates, because I would think that you would want to make sure that you're able to completely, be able to, if all else fails, if you lose your job, you still have enough reserves where you could make your payment for 6 months or so, and not have to worry about getting foreclosed upon when you have a 3.5% interest rate on a 30-year fixed mortgage. That would be devastating.
You should buy the type of house that you would buy that's equivalent to the rent that you might pay, where you get an advantage to buying the house. You should
Absolutely.
buy a house where the mortgage is twice the rent that you might pay.
Yeah, I totally agree. We're coming up on a break, guys. When we come back, appraisals are still killing real estate deals, and I'm going to let you know why when we come back. Stay right there.